The Federal Reserve recently announced that it was going to be raising interest rates 3 times this year. Now, what can that mean for you if you're planning on making a move in 2022? Well, that's what we're talking about today. This is Monday Mornings with Mark. Hi, I'm your host, Mark J. Schmidt of RE/MAX Country and MoveMeMark.com, where I help you get the most out of the real estate market and your home. If you're new here, be sure to subscribe to our channel on YouTube and make sure you like us on Facebook so you don't miss out. Now, like I said, the Federal Reserve is planning on raising interest rates 3 times this year. And in fact, interest rates have already started going up. So what can this mean for you if you're planning on buying or selling a home? Well, first, let's talk about what's going to happen if you're selling a home. When interest rates go up, what happens is you actually start having a reduced pool of buyers that are available to buy your home. Now, why is that? Well, when interest rates go up, now that buyer has to spend more money on interest than they were previously going to be spending on principal. So now they qualify for less money. So that's going to mean fewer buyers who are available to buy your home. Now, the good news is this. It doesn't necessarily mean that you're going to have a problem selling your home, because let's look at history. In the early 2000s, when the market was super hot, before the crash that came in 2007, 2008, Alan Greenspan was head of the Federal Reserve, and he had planned on putting the brakes on the market, so he said, we're going to raise interest rates. Well, when they raised interest rates, what happened? The brakes didn't go on the market. In fact, it actually pushed more buyers out into the market, because the buyers who were on the fence all of a sudden were like, uh-oh, we better act now before interest rates get too high. So that action of raising interest rates pushed more buyers out. So I think we're going to see that. Listen, over the long term, rising interest rates can definitely lower the number of home sales that happen per year. But in the short term, we're going to see more buyers come out, and I think that can be really great if you're thinking about selling your home. Now, if you're thinking about buying a home, yes, you're going to maybe qualify for a little bit less of a mortgage than you would have qualified before interest rates went up. But the good news is this. When the interest rates go up, yeah, maybe you qualify for a little bit less, but it's not going to be a tremendous amount less. And the Federal Reserve isn't going to raise rates at such an extent, and at least not all at one time, that you're going to have any sort of shock to your system. We're going to see interest rates go up maybe a quarter of a point. A quarter of a point rise in interest rates won't really lower the amount that you qualify for appreciably, okay? Now, you might pay a little bit more for your monthly payment. So if you figure that, say, a quarter of a point rise in the interest rate is going to mean that you stand to pay maybe $30 or $40 extra per month on your mortgage. And not something that's really going to kill you, but you know what, as I like to say, paying a little bit more on a mortgage for a home that you own is better than paying rent on a home that somebody else owns. So keep that in mind. I think that it's still a fantastic move. You get lots of tax benefits for owning a home. And listen, you need a place to live. It's better to build equity in your own home than in someone else's home. Now, the big question that everyone has is the market going to crash? And I have to tell you, I don't see that happening. I see people trying to make comparisons to the market now, back to the market in the early 2000s when the market did crash. And we have such a different scenario going on now. Right now, we really do just have good old-fashioned supply and demand. Back in the early 2000s, a lot of people were getting into homes with mortgages that were really risky. The banks had really much looser lending standards. And now everything has been tightened up. So you don't see people buying homes with 100% financing. Someone would buy a home, they'd get an 80% loan for 80% of the mortgage, and then they get another 20% loan for the other 20%. So in effect, they had 100% financing. And what happens with 100% financing? If the market crashes, if anything dips, you could be upside down on your mortgage, and that's not good. Now, on top of that, a lot of people were getting into these adjustable rate mortgages, where the interest rate only stays fixed for like 2 or 3 years, and then it starts adjusting. Well, when the rate adjusted too much for some of these people, they found that their payments weren't something they could make. We don't see a lot of people with these adjustable rate mortgages now. Most people are just getting into fixed rate mortgages because the rates are still so low. On top of that, more people are putting money down now when they're buying homes. They're putting 10, 15, 20% down on the home that they're buying. So we really don't have that fear that, if the market dips, they're going to be underwater on their home. So I don't see a crash coming. I do see possibly the air coming out of the market sales a little bit. I see maybe homes are not going to go with, 10 or 20 offers the first weekend, but I think it's still going to be a good market to sell your home. Now listen, if you have questions about buying or selling a home, there's a fantastic resource. It's my website. You can find me at www.MoveMeMark.com. Thanks so much for watching. If you missed our last episode, I've got it right here for you. And here's another episode that YouTube thinks you should watch. If you haven't subscribed yet, make sure you hit that circle and subscribe so you don't miss out. And I'll see you next time for more Monday Mornings with Mark. You have a great week.